How to invest in mutual funds for beginners in India. AMC website, investing in mutual funds directly through the asset management company, AMC, website can be done online and offline. To initiate the process, investors must open a new account, provide personal information, complete the FATCA form, and share bank details. KYC will be verified through Aadhaar, and funds can be sent after submitting a photograph of the cancelled check. Offline, one can visit the local AMC office and apply for an offline investment by submitting the required form, KYC papers, and payment. Demat accounts. Alternatively, investors can opt for online investment through their existing Demat accounts. No additional effort is required. Current Demat and bank accounts can be used to invest and trade in mutual funds. Log into the Demat account, find the option to invest, select a fund, and complete the transaction by transferring the required funds online. How to invest in mutual funds through SIP. To invest in mutual funds through Systematic Investment Plans, SIP. Complete KYC online by filling out the registration form and providing self-attested identification and address verification. Visit the fund house's website, choose a suitable plan, and apply by providing your name, phone number, PAN number, username, and password. Enter bank account details, set up the SIP autodebit amount, and you're done. For a beginner's monthly SIP investment, make the first payment online and the second installment 30 days later, as notified by the AMC. How to invest in mutual funds through lump sum investments? To invest in mutual funds through lump sum investments, set up a direct mutual fund investment plan with an asset management provider in person or online. Complete KYC by submitting a self-attested ID, address proof, and 2 passport-sized photos. Select the desired investment strategy on the mutual fund company's website, choose the one-time option, and enter the amount. How to exit mutual fund investments? If you bought mutual fund units through your Demat or a mutual fund trading account via a broker, you would sell them by placing a sell order with the same broker. The proceeds from the sale will be credited to your bank account, which is linked to the Demat account. Many investors purchase mutual funds directly from the AMC or through distributors. These platforms allow you to buy, monitor, and sell your mutual funds online. Registrar or transfer agencies, RTAs, such as CAMS and Kafin Technologies Limited manage transactions and records for mutual fund houses. You can also redeem your mutual funds through these agencies. Small case versus mutual fund. Small case and mutual funds represent two fundamentally different investment options. Exploring mutual fund investments reveals contrasts with small case offerings. A small case is essentially a collection of stocks or ETFs curated based on a specific theme or investment strategy. On the other hand, a mutual fund aggregates capital from several investors to create a diversified portfolio, which may include stocks, bonds, or other financial instruments. In a mutual fund, investors essentially buy units or shares, representing a portion of the fund's holdings. Here is a table of comparison between a small case and a mutual fund. Taxation on mutual funds. Understanding the taxation of mutual funds involves recognizing several key factors. These include the type of fund, such as equity, debt, or hybrid funds. Additionally, dividends distributed by mutual fund houses and capital gains from selling assets at a profit impact taxes. The duration of holding mutual fund units is crucial. According to Indian tax regulations, longer holding periods result in lower tax liabilities. Essentially, the longer you hold your investment, the less tax you will pay on capital gains. Fees and charges on mutual funds. Entry load. When investors initially invest in a mutual fund scheme, they may encounter an entry load. This fee covers distribution costs and used to vary among fund houses in India before 2009. However, current SEBI regulations prohibit fund houses from charging entry loads. Exit load. Exiting a mutual fund scheme within a specific period triggers an exit load. This fee, typically around 1% of the redemption value, aims to discourage premature withdrawals and reduce the volume of redemptions. Fund houses commonly impose an exit load if units are redeemed within a year but exempt investors from this fee after 1 year of investment in the same scheme. Transaction charges. Investors may face a one-time transaction fee, ranging from Rs. 100 to Rs. 150, on investments exceeding Rs. 10,000. This fee also applies to SIP investments above Rs. 10,000, while investments below Rs. 10,000 are exempt from transaction charges. Expense ratio. The expense ratio is a percentage of a fund's daily net assets. Asset management companies charge an annual fee for managing mutual fund schemes. It encompasses costs such as sales, marketing, administration, distribution, and fund manager fees. Calculated by dividing total expenses incurred by an AMC's total assets under management, the expense ratio tends to be higher for regular plans than direct plans, as discussed further in the subsequent section.